So please, in your personal reading, practice more on investors ratio. But it's very, very crucial in the advanced financial management. We also talk about the limitations of ratio. We've done this parallel to this time, so I expect everybody should have an idea of what the limitations of ratios are. And we also spoke briefly on WACC. WACC is also very key in the advanced financial management. I don't know if you can hear me clearly, and my background is not affecting you.
Yeah, I can try.
Okay. All right. So let's move on. So we talked about the weighted average cost of capital, where we said the average cost of long-term finance is known as the WACC, and this is the formula which we have the market value of equity by the total market value of both the equity and debt, where you multiply by the cost of equity geared. Please note, it's cost of equity geared, right? So in advanced financial management, there's something called cost of equity geared and something called cost of equity ungeared. But for the ungeared parts, we are going to be talking about that when we get to APV. So just note that cost of equity ungeared. But here we make use of cost of equity geared, right? And so in addition to the value of debt divided by the total market value of equity and market value of debt, multiplied by the cost of debt and 1 minus T. So that's the formula for WACC. So, and we're supposed to treat questions on WACC, investment appraisals, and questions relating to role of financial advisors. Yeah, that was last week, but the class did not hold. So we'll be going through questions on WACC today. And maybe briefly we'll talk about investment appraisal if time permits us. Any question before I continue, please?
This Indomie, how much? Okay. This question on based on the investment, sorry, the question on WACC. I don't get that much. Maybe you explain a little. Let me.
So my question is: I don't believe you've done something related to WACC prior to this time,
yes.
Right? Okay.
Yes, in stock valuation.
Evaluation. Yeah, that's fine. That's fine. Yeah. Yes. So, and I believe you have an idea of what it takes what it entails. All right.
Yes.
So we just want to solve few questions on it just to refresh our memory on WACC. So who has so start to bring our knowledge to just to refresh our knowledge and we'll continue from there. So
okay.
So I have this question. on WACC. I want us to read it. If possible, you can keep it somewhere while I solve, because I'll be making use of the Excel to the Excel platform to solve the question. So this does this question. This is a refresher question, just to refresh our knowledge. So have we noted it? Can I continue?
Yeah, you can continue. Ordinary shares reserves loan 10%. Okay. How much money do we give? Okay.
All right. So
hello.
That is 3,000. Your loan is hello, can you?
I'm not hearing very clearly.
Oh. What about others? Can you hear me clearly? What about now?
Yes.
It's like you're breaking. There's a break in transition. There's always like it's cracking.
My network is okay here. Can any other person confirm that? Is there a break in transmission or is it from me?
Let's continue. It's like it's going now.
Okay.
I can hear you now.
Oh. Hold on, let me see if this class is being recorded. Sorry, please. I want to confirm that the class is being recorded. Yeah.
Okay. I use I did for online class. Eh,
Yeah. It's being recorded. All right.
okay. So we should proceed.
So let's proceed.
Transmission.
I'm trying to bring up an Excel template so that we can answer the questions. Yeah. All right.
Okay.
So let me know if you can see my Excel screen, please.
Not display. Okay.
You can see, right?
You are seeing it. Like this. Yeah.
Okay.
Yes.
All right. So the question says ordinary shares 2,000, reserve is 3,000, loan is 10%.
1
And
10%.
the ordinary share, the market value is 3 naira 75 kobo. Loan note market value is 80, right? Equity cost of capital is 20, debt cost of capital is 7.5 post-tax. So what this question is telling us that we don't need to they didn't give us pre-tax, so they've given us the post-tax. So there's no need for the 1 minus C in the formula. You can look back at the formula and try to understand that. So what do we need to do first? We need to add the total equity. As you know, for equity, what makes up your equity is not just your ordinary shares, right? So we have, normally in normal financial statements, you have your share capital, you have your share premium, and you have your reserves. So the totality of that makes up what? Your total equity, right? So
Yes.
for this question, so for this question, they said the ordinary share is what? Ordinary share is 2,000,
3,000.
and reserve is 3,000.
Not share 2,000. Reserve 3,000. Loan is 10%.
Yeah. So what's your total equity? The total equity will be what?
That is, it should be in addition of 3,000 plus 2,000.
Yeah. So this is your total
10%
equity,
of
right?
yes.
Yeah. So this is your total equity. We learned that the loan is what? The loan is 1,000, right? So this is 1,000. So meaning that total value of equity and debt is what? 1,000 plus 1,000.
Equity 2,000. That's fine. Okay.
Are we on the same page?
Yes.
Uh-huh. So if the total value is 6,000, now let's move on. So how do we calculate the WACC? So what would our
Sorry,
WACC be?
that 10%. How do you calculate that 10%? 10% on the total of that is 10% on the total of ordinary share and reserve. Is it the total you calculated 10% on? The loan, the 10% on loan.
The loan is 1,000.
When I'm asking, I think I thought you used the 10% on the total amount or the total.
I've not even used
amount
I've
that
not
you
used the
created.
10% at all.
Okay.
I've
That
not even
1,000
used
is
the 10.
given.
This 1,000 is given in the question.
It's given. Okay.
Let me go back to the question so you can see it. This is the question.
Okay.
You can see ordinary share 2,000, reserves
ordinary share is
3,000,
2,000.
loan
Okay.
10%,
I've seen it.
1,000.
Loan is
You're seeing it, right?
okay.
All right.
10% of okay.
Yeah. So let's move on. So how do we calculate our WACC? So like we said, you're combining all your the weighted average of all everything, whether equity, whether debt, you are combining together to get a single WACC. That's
Okay.
a single cost of capital, which is called WACC, right? So it's weighted average, right? So how do
Weighted
you do
average
that?
cost of capital.
Yes, weighted average cost of capital. So how do we go about that? So for the equity part, like I said, WACC is your value of equity divided by what? Your total value
Yeah.
multiplied by your cost of equity plus your value of plus the value of debt divided by the total value multiplied by cost of debt, which is KD bracket 1 minus C, right? That's in the formula. You can read that up. So how do we calculate our WACC? So our WACC will be this 5,000, right? Divided by this 6,000. Yeah. Okay, let me state let's state this thing here. So our cost of equity, which is KE, they said it is what? In the question, cost of equity is what?
Cost of equity is 5,000.
No, the cost. Cost of equity
Okay, the cost of
is in the question. Or we didn't note it in the question. Sorry, please. The question. Did we write it down? Did we like take a picture? Okay, this is the question again. Anybody, please. Cost of equity. Please, do you have someone in the class, please? Hello? Hello, Z Bosun Ostino. Ostino, have you noted the question? So I can continue. All right, Z, I can hear you. You can speak, please. Okay, 20%. Oh, thank you. I wish your mind. So the cost of is what? Is 20%. So let's move on. From the question, what's the cost of debt? What's the cost of debt? They gave us the post-tax cost of debt after tax, right? So, which is KD. Please note, it is post-tax. If it was pre-tax, we are meant to get our post-tax, right? They would have given us a tax rate. So, but yeah, they've given us a post-tax cost of debt. So we just plug in, and that is 7.5%, right? So how do we solve this? For WACC now, to do by the total value, right? You're going to bracket that. That's multiplied by what? Your cost of equity. Most times I like to bracket all so that it won't affect my formula or anything. So you bracket all and plus your market value of debt divided by your total value multiplied by your post-tax cost of debt. What do we have? This is WACC. Question, please. Anybody, please. Are we clear on that? All right. So let's move on. So what have we gotten? From the question, you will notice that they told us to calculate WACC using what? Using book value and using market value. So what we just did was what? We calculated WACC using book value. And what's book value? Book value is what you have in your books at the moment, right? It's not what is reflective of market realities of what your ordinary shares currently worth in the market. So it's what is on your statement of financial position at the moment. So that's what's using book value. Now, the first one we solved was using what? Book value. Now let's move to the second one. In the question, they said we should calculate WACC using what? Market values. So for market value. Sorry, please, are we following? If you are following, please let me know. Because silence means that you are okay. Is there any message? Zinato, I can't hear you at all. Can you try again now? Sino, are you still with me?
Mhm. Hello,
Sino, are you with me?
I'm with you. I'm with you.
Okay, so did you get the work I did, the book using the book value?
You said 20%, 20% on the total or equity cost. Hello,
Yeah, I'm with you.
you're asking about the total equity cost, 20%.
Oh, that's where you stopped.
Yes, I lost.
Was it network issue?
It was network issue. I'm trying to like I missed that aspect.
Okay, let me just. This one, everybody is having network issue like this. I think you're even the only one on the call. Zinato has been trying to come in and go out.
It's network.
I understand. You know, that's what me to my first experience, but I think mine is better now. So let's move on. So I said, based on the work formula, I believe you know the work formula, right?
Yeah.
So based on the work formula, we are meant to what? You're meant to multiply what? Your just see my Excel, which is 66, which is your market value of equity, right? Divided by the total value, multiplied by your what? Your cost of equity, plus your what? Plus your market value, plus your value of debt, which is this guy,
Debt.
divided by the
Okay.
total value, multiplied by your cost of debt,
Okay.
right? And most times in questions, they don't usually give you post-tax cost of debt. They give you pre-tax cost of debt.
Pre-tax.
So you are the one that is supposed, most times they give you pre-tax cost of debt. So you are the one to make sure that you strip out the tax elements to get your what? Post-tax cost of debt. So let's say this question, this was pre-tax cost of debt, this 7.5, and they gave you a tax rate. They give you a tax rate of 20%.
Okay.
Right? How do you get your post-tax cost of debt? What you just need to do is this pre-tax cost of debt, which is 7.5, multiplied by 1 minus your tax rate. Right?
Okay. 1 minus 20%.
Yes, 20%. So you get 6%. This is your post-tax cost of debt. Do you get?
Okay.
So it means that in this question, because they've already given us the post-tax cost of debt, so you don't need to do that, right? So you assume, right? So and you get your work based on what I've done. So I will share this. I will share this Excel with us at the end of the class, right? Because these are you'll be working in the exam. You'll be working with Excel for calculations. So you have to learn and master how to work with that. So let's move on. So in the question, you will notice they said we should get the what? The book value and the market value, right? Of
Yes.
book value, right? And what based on what? Market value. The one we calculated is the book value. And why is it book value? Like I said earlier, I don't know if you got that. I said this information we have, right? This statement of financial position is what is in the company's book at the moment, right? It's not reflective of market conditions.
Okay.
Sure, you get it. Is your book value what is in your book at the moment, right? Historical or whichever way. But now they said we should calculate based on book value. So all what we did was we got that from the what? From the statement of financial position in getting the what? The book value WACC. Now, how do we get the market value WACC? Market value. They've given us in the question that the ordinary shares, the market value of the shares is what? 3.65.
6575. The market value of the ordinary shares.
Yes. So the market value of the ordinary shares is what? 3.75. And the loan note is what? 80.
80.
Right?
Yes.
80. And you know, normally in the way bonds are being treated, they are treated in bundles of hundreds, right? Meaning that if they give you 105, right, it means that when you are getting the market value, it means that you are doing what? 105 divided by 100 times the loan note value. Do you get?
Yeah.
So why this one now? The loan note market value is 80. So it means that 80 divided by 100, right?
Yeah.
It means 80 divided by 100. So let's now work. So how do we do that now? All we need to do is just we can copy this again for the market value part. This equity side. They told us that the ordinary share, right? The ordinary share is 3.75 kobo, if I'm not mistaken. So we have to calculate the current market value, based on the market value. So let me create this. So now 3.75, right?
Yeah.
So now the market value will now be this market value, this book value. Market value will now be this multiplied by 3.75. Are we clear?
Come again, please. Come again. Let me get that place very well.
This is the ordinary shares, right? This is your ordinary shares.
Ordinary share, book value.
Yes.
Okay.
Now, your ordinary shares. The assumption here is that this ordinary share is traded at, let's use Naira, 1 Naira per share.
Okay.
Right?
Yeah.
1 Naira per share. If it's traded at 1 Naira per share, that's the nominal value. Right? Nominal is 1 Naira per share. What does it mean? It means that if this 2,000 Naira, for instance, right?
Yeah.
It means that your total number of shares will be what? In issue. It will be 2,000 divided by 1 Naira now. Abi?
By 1 Naira. Yeah.
So it means that you have total 2,000 units of shares.
Yeah.
Are we clear?
Yeah, I'm with you.
If you have 2,000 units of shares, if they not tell you that the market, what's the price of your shares at the moment is 3.75 kobo in the market. That's
value.
what is traded at.
Yeah.
How do you get your market value? Your market value will be your total number of shares multiplied by the current market value of your shares in the market, right?
Okay, yeah.
So meaning that this market value, which is 3.75, multiply it by the unit of shares you have.
Okay.
Yeah. So which is
by the book value.
By book value or the unit of shares, which is the best unit of shares. Because the unit of shares is 2,000. That way you are multiplying by.
Yeah.
You know this 2,000, this book value you are seeing is in Naira.
Yeah.
Hope you know. Based on the financials, right? It's in Naira. So you won't be multiplying 3.75 kobo multiplied by 2,000 Naira. It will be by the total number of shares, which is 2,000. Do you understand?
Yeah, I'm with you.
All right. So if the current market value is 7.5, right? It means that the value of your equity at the moment is 7.5. What do you now do? Now you've gotten your market value of equity. Now you now want to get your market value of loan. And they told you that your loan is being traded at what? 8
80, yeah.
in the question.
Yeah, the market value of loan, 80.
80. So it will be 80, 80 divided by 100. That's what it is. Right?
That's
No, I told you that
zero.
it's done in bundles. Yeah.
Okay.
So
80 by 100 is not that's
So what-
0.08. I mean 0.080.
so this will be what? This multiplied by this. Oh no, it's not. It's not giving us a value. Let's do it this way. This 80 divided by 100 multiplied by 1,800. So can you see it?
Okay.
Yeah.
80, you did 80 divided by 100 times 1,000. 8%. 80,
Yes.
80%.
Yes.
Okay.
So it means that this is the market value of the loan.
Okay.
800 instead of 1,000, right?
Okay.
So what's now the total market value? It will be the addition of
Like 7.5. Addition of ordinary share market
yes,
value and that of the loan.
which is 83.
83. Okay.
So now we now need to get the WACC. What do I just need to do? I just need to bring this here, right? And switch up my okay, let me make it more neat so that this is the total equity value.
Okay. 5,000.
Right? Would be 822, 83, right? So now what do we need to do? We just need to bring this guy divided by 822, right? Just follow 822, which is the total equity value. I mean, total market value, right? Market
Okay.
value of equity, 75, divided by your what? E26. Your E26 is the addition of your equity value and your loan market value, which is 800, right? Which is 8,003, right? Multiplied by it's supposed to be multiplied by the cost of equity, which is this guy, 20, right? And also for the debt, side, E24, which is 800, which is this 800, divided by your total market value, which is 8,003, right? Multiplied by, it's supposed to be your 7.5 post-tax cost of debt, G22. We'll get the WACC. Are we clear? Any question, please?
I think I just need to master those formulas.
Yeah.
I just need to master those formulas.
The more you solve questions. So I will share this with us just for our knowledge. And so like I said, this is just a refresher question. These are not tough questions. These are simple questions. It's just to brush our knowledge. And please, you have to note this market value part, because most times this is what you'll be dwelling more on, right? From the market value concept for advanced financial management. Some questions come out from book value and all the likes, but most times it's usually because the market value actually reflects the current realities of your source of finance pricing, right? So most times the market value is mostly used for the computation of the weighted average cost of capital. So let's move on. Let me know who's parent in the class. Okay, so I have Z. Z, you're raising your hand. Yeah, I can hear you. Is that a node raise or? Okay, I have Toyon James. Hi, Toyon James. Good afternoon. Z, I still cannot hear you. I don't know. You can drop a chat. You can drop a chat, please. I can't hear you. I know you are trying to talk, but I cannot hear you.
Hello, can you hear me now?
I can hear you now.
Okay, it's better. Thank God.
Yeah, I can hear you now.
Okay, all right.
Okay, so you raised your hand. Do you want to ask a question or is an old raise?
I just want to know how you got the market value.
Market value
Okay,
is
so where
given.
did you miss? Which part did you miss, please?
I just want to see, just let me put your cursor on the 7.5. Let me see the formula.
Okay. This 7.5, right?
Okay. So the
So this is
375 is like the units. What's that 3.75? What is it called?
Okay, so if you notice in the question, see this question.
Okay.
In the ordinary shares, the market value means what is currently trading in the market.
Okay.
Your
I get
shares
it.
are trading at
3.75.
3.75.
Okay, thank
So if
you.
your shares are trading at 3.75, so it means that 3.75 multiplied by what? By the total unit of shares. Please, I want to correct you on something before I move on. And most students usually make that mistake, right? And fall into that error. Austin, if you remember, initially when I wanted to multiply the book value, I first did 3.75 multiplied by the book value, 2,000, right? If you remember.
Yeah. Yes.
And I said, no, that's not correct. Normally, you are supposed to get the unit of shares first.
Unit of shares.
Right?
Okay.
Yes.
I wanted to ask on something on that.
Okay. What's the question you wanted to ask?
On that unit, that same unit of shares that they want to explain now. I wanted to ask on that unit of shares that it's not possible for us to use to make use of that unit of shares in multiplying that market value.
Yes, it's a unit of shares we use in multiply the market value. That's what we did.
Okay.
If you notice, look at the Excel. It's multiplying I20, and I said I20 is 2,000 unit of shares, right? Multiplied by the market value, market price, which is whether naira, whichever way. But most time we'll be using let's just stick to dollar because you know this is ACCA now, so everything is dollar or pounds. So let's just work with dollar. So which is $3.75 right? So that's that about that. And I said sometimes, okay, let's do a twist now. If you notice, the reason why you're having 2,000 units of shares, right, is because your ordinary share, the nominal price is what? Is $1.
Yeah.
Right. So there's some questions that you will have 0.5, which is 50 cents, right?
Okay. Yeah.
You know when you have 50 cents, it will not be
that 50 cents
2,000 divided by.
You say cents. Sorry, you say cents. It's equivalent to percent. Okay.
No, not percent. Cents. You know the Kobo equivalent of dollar is cent.
Okay. Yes. Okay.
This is the cent I'm talking about, not percent.
Okay.
I can hear background noise, please. I can hear background noise, please. All right, so let's move on.
Let's move on.
Mute your mic. Mute your mic if you are not speaking, please.
Please, Austin, can you mute your mic? I think it's coming from you.
Sorry, were you talking to me?
You can carry on, thank you.
Okay, all right. Okay, so like I was saying, I said this if it was $1, right, it should have been 2,000 which is this 2,000, right, divided by $1, which is 2,000 units of shares. But I told you that, let's say for instance now the nominal is 50 cents, right, which is 0.50. You know, for you to get your unit of shares, you will divide your book value, which is on the financials, which is this $2,000 divided by 0.5, right? Your unit of shares will be what? 4,000 unit of shares. Is that clear?
Yes, it's clear.
Yeah, so please, let's take note of, like I said, so many students fall into that error, so they make errors a lot. So you have to check your nominal amount to be sure that, because some questions, you know, some people, they always think every time it's always $1. No, sometimes it can be 50 cents. So please note that, or write it somewhere. Note that, please. It's very, very crucial and very, very important. All right, so let's move on. I know if it was 4,000, it means that the market value would have changed for this guy, right? It would have been 3.75 multiplied by what? By 4,000, right? And your WACC would have been what? You can see that the WACC has increased from 18% to 19%. So I've let's note that, please. So that's simple WACC computation. And with this knowledge, permission to move on, please.
Go ahead. Thank you.
Yeah, I will share this with us just for our consumption. On the Teams page or the WhatsApp, whichever way. So let's move on. So now we now want to go to next part on WACC. WACC for project evaluation. I believe whether you are coming from ICAN, whether you are coming from ACCA, I want to believe we've gone through project evaluation before, and we have an idea of what it means to evaluate a project, which is an investment appraisal, right? Where we make use of a net present value, right? In making decisions on whether to invest in a project, to carry on the project, and so on and so forth. And if you also remember from your MPV, right? You know, when we get the cash flows after taking out the outflow, which is your capital, your initial outlay, right? Initial outlay, which you use in purchasing maybe your machinery or whichever way, and also the working capital that you've used. Those are mostly the outlays, right? Those are actually the outflows, rather, the outflows that are used. And we also have the inflow. Inflow is the cash flows. After you've taken your sales, less your variable cost, depreciation, which is your depreciation and the likes, right? We usually get something which is the adjusted cash flow, right? Which is the net cash flow. So after the net cash flow, if you remember, there's something we use in discounting those cash flow. There's something we use in discounting that cash flow to get the what? There's something we use in discounting those cash flows, right? To present value. You know, sometimes we might, okay, the cash flow, the project will take for 6 years, right? And we are going to get so number of cash flow each year, maybe for 5 years or 6 years. And if it's going to go into perpetuity, we are going to get the terminal value, right, of the amount. And the addition of all that, we are going to get the present value. We are going to discount it to get the present value. This is just investment appraisal. I believe you've done it. I'm just playing around it. And you will get the, you know, we'll get the cash flow, right? After the cash flow, we are going to discount it, like I said earlier, discount it to present value. After discounting it to present value, we are going to take off we're going to subtract the initial the outlay from it, which is the initial outflow. You know, and you know that one usually done at times 0, and it's not usually discounted, because why? We did it at time 0. So is the exact amount, the nominal amount. And after that, you get the net value. The net value is either, if it's positive, we carry on with the project. If it's negative, you reject the project. I believe we understand that. We are very intelligent people. So, but where am I going to now? Where we are going to now is now as a company, we might say, okay, we want to carry on another business, right? Let's say, for instance, now let me give an instance. Banking, for instance, now, Access Bank, right? Access Bank wants to take over, or maybe wants to diversify into let me say take over. Wants to take over maybe Zenith or GT. I want to ask a question. Access Bank taking over GT, are they facing the same business risk? That's my question. Can anybody answer that, please?
Obviously, yes.
Obviously, thank you very much. Obviously, they are facing the same business risks, yes. And they are in the same industry. So it means that WACC is most likely we may replicate our WACC in appraising GT. When I say replacing our WACC, it means I'm talking about things like our beta, right? Our beta asset and our beta equity. Because since we are facing the same risk, it's most likely the beta will not change, right? You know the beta measures our the risks in the business risks in the business you are taking over. So you might not need to change the beta. But if you are moving into another industry, right? Let's say, for instance, you are going into manufacturing. Maybe Access Bank want to diversify and invest in the manufacturing business other than its core business activity. It means that the business risks that is going to be facing is going to be different from what is facing in his own business. So we might need to get another beta, right, in the computation of our work. I know, like I said, I'm working with the assumption that some of us are through from the skill stage of ACCA. So these things are not strange to us when we talk about beta equity and beta assets. So I have it here in my notes. When adjusted WACC for project evaluation, and I'll read it. It says when existing WACC cannot be used, right? A company existing WACC should only be used as a discount rate for a potential project if the project has the same business risk as the company's existing activities, which I've said earlier. Like, for instance, when Access Bank wants to maybe take over GT or invest in GT, whichever way, or appraise GT, right, for purchase or whichever, or merger or acquisition, whichever way they want to go about it. This usually means that the project is in the same business area. I've said that the project has no impact on the gearing of the company. Yeah. Where either of these conditions is not met, alternative approaches are required to assess an investment. 3 approaches are used in the AFM exam. So for this exam, for ACCA exam, we make use of 3 approaches. 1, an adjusted WACC approach. Use of capping to calculate the appropriate cost of capital. How many of us can remember capping, please? How many of us can remember capping? The full meaning of capping.
Capital asset pricing model.
Yeah, capital asset pricing model, yes. And we now have the third one, which is use of the adjusted present value technique. In that adjusted present value, that's where we'll be talking about cost of equity ungeared. I talked to us about cost of equity ungeared before, right? In normal computation of WACC, what we usually have, that KE is cost of equity geared. But in APV, it's called cost of equity. We make use of cost of equity ungeared to get the base case, the base MPV. We're still going to that, but at the back, the base MPV, we make use of the cost of equity ungeared. So now, then I said, which approach to use will depend on the information provided in the question. So it depends on the question we are giving, right? If the question is related to, if you see more of capping data, capital asset pricing model data, we're going to use capping. If you see more of adjusted present value data, we are going to make use of what? Adjusted present value. If we see more of adjusted WACC approach data, we are going to make use of adjusted WACC approach. So let's know that for what? When we are doing an evaluation of a project. We now have it here. Where a business is considering an investment in a new business area, right? Meaning that the what have you, the business is not related, an unrelated business. Like I said, let's say for instance, Access Bank wants to diversify to oil and gas or maybe manufacturing, right? You can see that the business risks they will be facing will be quite different. So it's not the same approach compared to when it's diversifying into a GT or what or a Zenith. And we have a here that the adjusted WACC approach can be used. Adjusted WACC approach can be used. This involves using the M&M second proposition and the related equation in the exam formula sheet to calculate an adjusted WACC, which can be used to discount the cash flow of the project. And we have the following steps, right? Before I move on, I want us to go and read on these M&M propositions. M&M propositions, very, very important. They are called capital structure theories. Please, I won't be the one to. I will not. The assumption is I said that we should go and do that study ourselves, right? And understand it. They are called capital structure theories. It's very, very important. You need to understand them, right? Where we have M&M proposition 1, M&M proposition 2, static trade-off theory, and the likes. It's an interesting read. It's not something that will stress you, and it's not something that is difficult, right? You can just go and read that at the end of this class. M&M propositions, the capital structure theories is very, very important for this class. So I was talking about the M&M second proposition, and that is what we use for businesses that are considering an investment in a new business area. And what are the steps that are followed that you need to follow? It's usually these 4 steps. First of all, you need to find a company that is already operating in the new business area, right? So if I want to invest in a new business, for me to appraise that business, I need to first look for a similar business that is operating in that new business I want to venture into. So for instance, I want to go into let's just even say oil and gas, right? We have different oil and gas companies, right? We have Total, we have Mobil, right, and the likes. So if let's say for instance now I want to invest into let's say Mobil is let's say I want to invest in a new business in oil and gas, right? The name of the new business is Segun Oil and Gas Venture, whichever way. For me to appraise that investment, since the business is new, Segun is new, right? What do I need to do? I need to look for a similar company that is operating in the industry I want to operate in which Segun will end up operating in, so that I can have a sense of idea of what I'm expecting from this business. And if I look around me, right, in the oil and gas industry, there are businesses that are already existing, right, which maybe Mobil or Total, as the case may be. So what do I need to do? I need to get those information from Mobil in appraising the potential, my potential investment in Segun, right? And what do I need for Mobil? I just need some data relating maybe their gearing, the beta assets, the beta equity, and so on and so forth, to have a sense of how my investment is going to look like when I end up investing in Segun. So we have it here. We said first of all, find a company that is already operating in the new business area, right? So which is usually called a proxy of benchmark, which is a standard, right? And ascertain the cost of equity of that company. So first of all, what do? We ascertain the cost of equity of that company, that particular company. If the proxy gearing is the same as the company's own, right, then the cost of equity of the proxy can be used to discount the cash flows of the project. If the proxy gearing is not the same, Then we what? Then we use step 2. Then step 2 and 3 must be followed. You might not get it all now, right? I understand it might be somehow, or maybe for those that really understand, you might understand better. But just follow as I'm saying, right? When we start solving questions relating to that, we'll get the logic better. So what do we need to do? So they said if the proxy gearing is the same as the company's own, right? Then the cost of equity of the proxy can be used to discount the cash flow of the project. Right? Our gearing is the same. Maybe our cost to our equity to debt ratio is 40 to 60. 40 to 60%. And when I say equity to debt ratio is 40 to 60, right? It means that equity is 40%, debt is 60%. If both of them are the same, the proxy company I'm trying to use, right? If they are the same with my own current gearing, what I just need to do is what? Is to use that particular company cost of equity, right? To what? Of the proxy to what? Discount the cash flow I'm expecting from the project. And the project is what? Shegun in this question, right? What I'm expected to get from Shegun if I venture into that what? Into that business, into Shegun. So it means that yeah. So we make use of what? Then the cost of proxies, if we don't have the same gearing structure, right? Then step 2 and 3 what must be followed. And what is in step 2 and 3? First of all, we need to ungear the cost of equity of the proxy, right? We are going to ungear it, meaning that we're going to strip off the gearing aspect of the cost of equity, right? Which is usually the M&M formula, right? It's used to ascertain what the cost of equity would be for a company in the same business area. But we know gearing the cost of equity of an ungeared company, right? So we make use of M&M proposition 2 in doing that. Now, in that sense, there are now 2 M&M proposition formula. Those ones are provided in the exam sheet, right? The second formula shown here is the first formula reorganized as easier to understand, easier to use in a spreadsheet. This formula can be used to ungear. So forget the story here. Just look at the formula we can use to ungear. Is the M&M proposition 2 formula, right? That's what we make use of ungearing. If you want to ungear on a particular company, right? To ungear it, we make use of cost of equity plus bracket cost of debt. You now take the value of debt divided by the value of equity, right? And that is it. The formula you are seeing here is also the same thing as the second one. So they are the same. There's no difference. And what do you now need to do? After you ungear, you now regear it. You get that ungeared cost of equity using what? Using your own gearing, right? And how do we regear? This is the formula for regearing. This number 3. This is the formula for regearing. When we start solving questions, you understand better. This is the formula for regearing. And after you do that, you now what? Put the regeared cost of equity into the what? Into the what? WACC formula. Are we confused? Or any question, please?
My question is, what's the difference between that formula 2 and formula 3?
So for formula 2 is to ungear. And when we say ungear, what do we mean by ungearing? See, in WACC, there's an element of debt in your cost of equity, right? There's an element of debt. So the reason why we ungear is to strip out that element of debt, right? Your current gearing, but we want to strip out the proxy company gearing from that cost of debt, right? So that's what we mean by ungear the cost of equity, right?
No, sorry to cut you. In that formula 2, what's the subject of the formula? Because I'm seeing a formula at the right side and also at the left side. What are we looking for? Like, is it KE or KEI in that number 2? Because obviously number 3 is KE that I'm looking for. Then for that number 2, what's like the subject of the formula?
So for this one, what you're looking for in this one is just the ungeared cost of capital, which is KIE. This is what you're looking for. KIE. This KIE. That's what you're looking for.
So that is the subject of the formula, Abi?
Yes, that's what you're looking for. KIE.
Can we get a formula where that KIE should just be on like a standalone something? Then the other ones can push forward. So it will not be a long formula, because I'm seeing a formula at the right hand side equals to KIE at the left hand side. I don't know if I'm making sense.
Okay. Let's ignore the one on the right hand side. Just focus on the one on the left hand side. Because they are the same, right? Focus. Can you see my cursor, my mouse cursor?
Yes.
So don't let me confuse you. Just focus on this. Sorry. Focus on this guy.
The first
focus on
one.
this guy for now. Yes, focus on this one for now.
So that is the formula
focus
for KEI, Abi?
For Hungarian.
For looking for KEI, that's KEI, Abi?
Yes. Your unget cost of equity. Yes. That's for looking for KEI. Yes. Your unget cost of equity. This is the formula you make use of. Can we move on?
Yes, please.
All right. So this is for looking for KEI. This is the formula. KEI plus 1 cost of debt, value of debt divided by value of equity. That's what we use in what? In Hungarian, your cost of equity of the proxy company, right? So, and most of the data you have in this formula is the proxy company's data, right? So we're going to get is cost of equity, right? Plus 1 minus is the tax rate obtainable is cost of debt, right? To get the post-tax cost of debt, bracket, the value of the debt of the company divided by the value of the equity of the proxy company. So you get what? You get your KEI, which is your unget cost of equity. After you've gotten your unget cost of equity, you will now regear, right? So I want to get the right cost of equity that will be applicable to my structure. That's the meaning. To my own gearing structure. So when you are regearing, by the time you are bringing data to this number 3, right? This cost of equity now, you now want to get your own cost of equity. You want to get your own cost of equity. And for you to get your own cost of equity, you make use of the KEI, which is the unget cost of equity you've gotten from this Hungarian in number 2, right? And you flow it back into the formula. 1 minus the tax rate, bracket the cost of equity unget minus cost of debt, which is your own cost of debt now. Your own cost of debt that is applicable to your own gearing structure, right? Multiplied by what? Your own value of debt divided by your own value of equity. In the second one, it was the proxies data we used. Now, what we needed from the proxies data is just what? This KIE, right? Now, in this number 3, it is our own data we are bringing in, our own information, which is our gearing structure, right? Data on our gearing structure. That is what we're bringing here to get our own geared cost of equity. If our gearing structures were the same, there won't be need for this long journey, right? But because our gearing structure are not the same, I and the proxy company, our gearing structure are not the same. I have to do all this, I have to follow all these steps, right, to get what? The right cost of what? Equity that will apply, that will applicable what? For appraising my what? The business. And after I get the cost of equity, what do I now do? I now calculate my WACC. See, all this stress we've gone through is to what? Get a geared cost of equity, right? And this geared cost of equity is this guy. Normally this question they had already given cost of capital for equity cost of capital, which is 20%. But in real questions on advanced financial management, you are expected to know how to get this 20%. So is how to get this 20%. Those are ways of getting those 20%, right? If we are taking if we are evaluating a project. And I want to ask, I want to believe most of us in our prior knowledge from SFM or ACCA. I believe we understand the approach of how to get equity cost of capital. Do I want to assume that we know that, or you want me to go back to that? The two ways of getting equity cost of capital. Can anybody assist with that, please?
I would say first way is either the dividends model or CAPM.
Okay.
Model.
You're on point. You're actually on point. Can I remember the second one?
A CAPM model.
Yeah, thank you very much. The CAPM model. Yeah. So for us to get this cost of equity, first of all, there are two approaches, which is the dividend model and the what, and the capping approach. So let me just brush through that. Please, am I not? My goal here is not to go back to the preliminary, right? Because the assumption is that you've gone through all this and we're speaking based on advanced financial management. So if I'm going back to all this, I'm just doing it out of benevolence, right? Because the assumption is that we've passed through all these stages and we are going to the more complex questions and scenarios. So let me just brush you on that. You said capping. Yes, this capping for refresher. So I know capping is an alternative what for the dividend valuation method to estimate a company's cost of equity, which is KE. And this is the formula. We have the formula of capping here, right? Which is the expected required return from an investment. And RF is risk-free return, which is this. Your ERM is what? Expected return from the market portfolio, less your what? Your risk-free, right? And you have BI, which is your what? Beta of the investment, right? ERM minus RF is called what? Market what? Risk premium. That means the difference between your market expected returns from the market portfolio and your risk-free return is what? The market risk premium. Which means, and when we say market risk premium, it means what the market is charging above what? The risk-free rate. So for instance now, if I want to invest in government bond, right? Which is the risk-free rate. So I don't know. Can you give me like 5 minutes, please? Hello, class. Please give me 5 minutes. I'll be right back. I need to change my location.
is what?
I seem like this. Maybe a bad to tell me what she want. Stress me. Stress me. I'm gonna get up to 3,000.
Hello.
You know, rich.
Are you still there?
For this one, I'm gonna give person now. That's how they can't tell.
Yes, we are. He just changed his location. He sent a message to give him.
He sent a message to you.
He sent a message to give him some minutes. He's
Okay.
changing his location. Yeah.
Okay.
Okay, yeah. So I'm back. Can you hear me, please? Hello?
Yes, hello?
Okay, so I'm back, please. Can you hear me?
Yes, we can.
Okay, so let's move on. All right. Apologies. I just had to change my location where it was getting very noisy and all right. So like I said, going back to the let me see if I have a question. So I said, okay, yeah, the better of the investment and the RF, which is your expected return from the market portfolio less your risk-free return, is called what? The market risk premium, right? Or equity market premium, or simply the market premium. And I was explaining the market premium, yes. And I said the market premium is, for instance, now if I want to invest in a government bond, right? And they say the government bond is 18%, right? And most times all government bonds, we see it as what? As risk-free, meaning that there is no risk in it, and the probability, or maybe the risk is very low. When we say risk-free, it does not totally eliminate the riskiness of the investment, of the government investment. But what we're saying is at least is very minimal or nil, right? And the probability that I will get back my returns and my interest is what is very, very high. So most government bonds are usually seen as what? As risk-free investment, meaning that it's safe to invest in those instruments. For instance, treasury bills, right? FGM bonds and the like, and so on and so forth. And if I invest in treasury bills 18%, for instance, right, and it's risk-free, it means that if I'm going to invest in a corporate instrument, let's say for instance Dangote, right? Or any other company in BUA, I'm not supposed to get 18% the way I'm getting it from FGN. Because if FGN is 18% and is risk-free, if I'm going to invest in a GT, or I'm going to invest in a BUA, my returns is supposed to be higher than 18%, right? Because why? There's supposed to be an element of the risks that Dangote may default. So it's supposed to be part of the pricing of the investment. So meaning that if the risk-free investment is doing maybe 17%, what I should be expecting from, let's say, from a Dangote investment is what? 21, 22, factoring what the element of risks in line with the company's rating, right? We're still going back to that. Bonds, when you're evaluating a bond or valuing a bond, we make use of ratings of those companies. All right, I'm with you.
Can we also classify cheap loans as risk-free?
When you say cheap loans, do you mean blue chip, or when you say cheap loans? I didn't get that on clearly.
Cheap, like CHEAP.
Cheap loans. Can we classify it as risk-free? No. The question is, those cheap loans, are they government instruments?
Okay. So all governments. No. So if we get those cheap loans from, let's say, from another institution, so they are not risk-free, right?
No, they're not risk-free. The idea of the cheap loan, you need to get that. Let me explain something. The idea of the cheap interest. When you say cheap loan, you mean the interest, right? The interest is low. Is that what you mean? Let me be on your page first. Is that what you mean? That the interest is low, right? Is that your definition of a cheap loan?
It's subsidized debt, kind of.
A subsidized loan means that the interest rate is low, like it's lower than what is actually obtainable in the market, right?
Yeah, so something towards that direction. So can we apply risk-free rates to subsidized loan?
No. They are not the same. The reason why an investment is risk-free is not because the interest rate is low. No, let's get that first. The reason why it's called a risk-free investment is that the probability of default is low. Let's get that first. If it's subsidized, that's a different conversation entirely, right? But first of all, let's first get concept first, principle. The reason why a risk-free instrument, why, is risk-free. Why it's called risk-free instrument is why, the probability of default. It means that if me, as a bondholder, let's say for instance, I buy Dangote's shares or stock or bond, whichever I subscribe to his shares, right? For instance, right? And I've parted with cash, is with my funds, right? And I'm getting dividend on intervals, as the case may be. It means that by the time Dangote is going to pay me back, right? No, it means that what I'm saying is, when we will pay me back is very high, meaning that I can go home and sleep and be sure that my dividends and my capital will return back to me when I call for it. So, and the assumption is that all government instruments are risk-free. First of all, risk-free in the sense that government will not hold you. That's what we're saying. Government will pay you back your interest and your capital. That's why most people prefer to invest in government securities, right? That's the idea first. And where I was coming from when I say a corporate bond might be higher than a risk-free instrument is because why? Normally in pricing of instruments, what people used to start with first is, first of all, we use the risk-free rate as a benchmark first, government bond, because why? It does not contain any risk, right? So it means that if I want to invest in Dangote or I want to invest in BUA, right? The assumption is that we want to believe that Dangote will have a risk element because it's a corporate entity, right? You can't compare a corporate entity to a government instrument. Government will remain with government will not collapse. Government will stay. Government is here to stay, whichever way. But anything can happen to Dangote. So there's a risk element in Dangote's business, right? That it can be human risk, it can be any risk. Anything can happen to Dangote at any time, right? The probability that Dangote is going to be a going concern, we cannot ascertain that. Anything can happen in Dangote's business. So there's a risk element in Dangote business, and those are what rating agencies do. They rate businesses based on their risk profile and whatever they are facing at the period in time. We are still going back to all those conversations on bond when we are valuing bonds, right? So now, one of the things as an investor, if I want to get a Dangote bond, right? For instance, I'll look at what is government doing. Let's say government is doing 17% and is risk free. By the time I'm getting Dangote's bond, I will add a premium because of the risk that I know that is in Dangote, that might be in Dangote, based on the rating. That is what Dangote will use in valuing his own bond and give me a higher percentage. Meaning that, okay, because of my risk profile and blah, 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 my own will be will be maybe, instead of, if government is doing 18, Dangote may be doing 19 or 20, meaning that he has factored in a premium on the bond so that it can be it can reflect the risk element in its business. So now, going to your own question on subsidized loans. Subsidized loan is different. Subsidized loan doesn't mean the loan is actually cheap. They only subsidize it. It means that the other party is bearing the cost, the remaining cost that would have been bared by only you alone, right? So subsidized loan is a different ballgame entirely. It has been subsidized, meaning that both parties are bearing the cost element. It's just the way the government was carrying on costs on energy, right? Before they canceled the subsidy regime, and all the cost is being bared by us alone. If you notice, prior to this time, government was taking a burden on those costs. They had their own fair share of the cost elements. But now it's totally on us, the consumer. That's why we are buying fuel at 900 or 700, as the case may be. I don't know if that answers your question.
Yeah, it does.
So let's now go back to capping. So like we said, I already said the market risk premium is the difference between the market portfolio, expected return from the market portfolio, instance Dangote, expected return from Dangote's portfolio, less the risk-free return, which is the government bond. That premium is that risk element that's been factored into Dangote's instrument, right? Of cost of equity using the capital approach. I think there's a question on that. Let me just illustrate. I have a question on that, illustration 3, in one of my my question sheets. Let me see if I can bring that up. Okay. Let me see. Okay, I don't think I have it here. I'm coming, please. All right. So I think I have it here. Okay. So this is a short question on equity on capping, right? So they gave us this question. The equity beta of a company is estimated to be 1.2, right? And the risk-free return is 3%. Estimate the cost of equity of the company if the market risk premium is 5 and the expected return on the market portfolio is 9%. Can we see this?
Yes.
Okay. So I know we said so let's just quickly solve this down here. I know we said what's the formula for capping? Using illustration 3. What do we say the formula for capping is again?
RF. That's a risk-free plus.
Okay, so which is
RF plus beta bracket market premium. No, expected market returns minus risk free.
Yeah. So is direct. So we have our equity. You must understand capping very well. Capping is very, very important in AFM. We hardly even use the dividend model approach. It's usually mostly capping. So please, you have to understand capping very well. And most mistake that people fall into again is some people mistake the market risk premium for the market portfolio. People make that mistake a lot. Please don't make that mistake. Some people mistake the market risk premium for the market portfolio, right? So we have our equity beta. Yeah, please. I know what I'm telling you. I've been a student before, and I know all the footfalls there. So that's why if you notice, I'm giving you some notes so that for you not to make errors. There are simple things, but people fall into that error a lot, and people just miss it. So the equity beta is what? 1.2.
0.2.
Yeah. Our market risk premium, risk free. Let me look. The risk free is risk free 3. Let me just call that risk free RF. 3%. We also have the equity bet. We have the market risk premium to be what? To be 5%. Market risk premium. Let's call that one RP. We have that one to be 5%. We have the expected return on the. Let me just see that one MP. That one is 9%. And they say what? Calculate what? The cost of equity. So from one, they've given us the risk premium, right? If they've given you the risk premium, what do you not seem to do? This is your risk premium, 5%, right?
Yeah.
5%
Plus 1.2.
plus 1.2. Okay. What again?
In brackets.
You are very intelligent. Okay. What next?
I think 9 minus 3.3%. 9% minus 3%.
Okay. So you're looking at it. Okay, so we made an error somewhere. We said C38. It's not supposed to be C38. It's supposed to be risk-free now. The risk-free rate.
It's RF 3%.
C37. So, like I
Plus.
said, there are two ways. There are two ways you can do this. Because why? They gave us a risk premium and they gave us a market risk premium. They also give us expected return of portfolio. So there are two ways you can go about this. Two ways you can go about this particular question, right? This is it. First of all, this is your risk-free 3%, right? Plus your beta, right? Beta multiplied by your market risk premium. No, hold on. We multiply by your market risk premium. This is the first way you can do it. There's this part. And what do you get? You get 9%. There's now another way. I will explain. The other way is this. Your equity beta, right? Your risk-free.
Risk-free plus
your
equity beta.
Let's bracket this one first. Equity beta, right? Multiplied by
9 minus 3.
9 minus 3. Thank you very much. 9 minus 3, right? And what do we have? I'm supposed to, accept 10%. Can you see the difference? Any question?
Yeah, why are they different?
So the reason why they are different is that number one, it's just to show you the different ways on which you calculate it, right? If it was going to be the same, they would have done it this way. If they wanted it to be the same, they just wanted to show you something in this question. Look at your expected market portfolio, right? Normally, your expected market portfolio less your risk-free so it's meant to be this market risk premium, right? Meaning that this question would have, let's say this one was 8%. I know this is what you were expecting.
Yes.
Both of them would have been 9, right?
9, yeah.
But what are they trying to draw out from this question? They're just trying to solve two. Trying to solve two questions in one. They're trying to solve two. They are trying to bring out two solutions from one question. Meaning that in a question, right? In a question, you are not going to have it as you're not going to have full data like this. Let me start with that. The question will not be this way. The question will be in this way. They will say the equity beta of a company is estimated to be 1.2, right? The risk-free return is 3%, and the market risk premium is 5% that I gave you. Another, right? And say the equity beta is estimated to be 1.2, risk-free return is 3%, right? The expected return on the market portfolio is what? 9%. Are you getting me? Are you following?
Yes. Yeah.
So meaning that they're expecting you to get this market risk premium. And to get this market risk premium is 9% minus 3%, right? It's supposed to give you the risk premium. This question is just trying to solve two solutions out of a question. Normally, if they wanted to structure it the way you are expecting it, they would have made this one maybe 8 and you will get the same answer. But they're just trying to make you understand that in a question, it's going to be either of this, either of A or either of B. That's what you see in a question. You won't see it like this way. And that's why I said most students, because they are used to this second way, this market portfolio, even when they give them market risk premium of 5%, right? And they say equity beta is 1.2 and the risk-free return is 3%, they will still go ahead and do like this. Let me use that first one. They will still go ahead and use 1.2 plus C36. C36 is supposed to be the market risk premium, 5%. They'll go and use okay, sorry, on the second formula, they will go and use, instead of using C39 in this place to get the market portfolio, they will use this 5%, which is the market risk premium. They will still go ahead to get, and if you are getting this, you are what? You are totally wrong, right? So sometimes the examiner may want to. Okay. I thought you were talking to me. So sometimes the examiner might want to confuse you, right? So your eyes need to be opened to see clearly what the risk premium and what expected return on the market. I don't know if that's clear. Can we move on?
Yes, we can.
All right. So that's that for capping. So you made mention of DVM, dividend model approach, right? Let me see if we can touch on that real quick. All right. Let me see if I have it in my slides here. Okay. So I don't have it. I don't have it on my slides here at the moment because I was not expecting to take that. But let me just run through that. Let me just run through that quickly. Just refresher. Can you hear me, please?
Yes, we can.
Okay. So let me just move to this part. Let me move to Excel. Let me work with Excel. So for using the dividend growth model, right? Two things. Your dividend using the growth model can be what? To calculate your cost of equity. We can have what? We can have DVM, which is dividend valuation method. It's called dividend valuation method, DVM, right? There are two ways. It can be with or without growth. You need to know that first. So your DVM can be with or without growth. And what are we saying here? It means that the share price can be calculated. You know DVM, we make use of share price. It can be calculated assuming a growth in your dividend. Meaning that most times when we make use of DVM, right, we usually use it to calculate share price, if you remember. And to calculate your share price, to evaluate your share price, to value a share price of a business, we make use of dividend, of the future streams of dividend, right? Either is what? Either is going to grow, or is going to remain constant in what? In perpetuity. And the one without growth is this. You have your constant without growth. You have your what? Constant dividend. Divided by your cost of equity. If you remember, right? And for questions like this, right, they will give you the cost of equity. So no, they will even give. Okay, when we were doing, like I said, we use it for valuing shares, right? For valuing shares, this dividend growth model, right? We use it for valuing shares to get the share price of a business. And in questions, if you still remember, they will give you the cost of equity. The question can, let's say for instance now, cost of equity is 5%. Okay. No mind, and like I said, I didn't prepare for this, so I'm just giving a short, just to a refresh. Your cost of equity. Let's say your cost of equity, they will give you in a question 5%, right? And let's say the constant dividend. The dividend is what you expected to get from the investment. The dividend is going to be constant over time, right? We're not expecting it to grow. Meaning that if they say, okay, they will be giving you a dividend of 2 naira on your investment, 2 naira on your investment, it means that you're going to be having 2 naira or $2. Let's stick to dollar, because this is AFM. So $2 on a yearly basis. It means that it's not going to change. So that one is without growth, right? So it means that if my constant dividend, is $2, right? $2, and I want to get the share price, right? This is without growth. Let's note, this is without growth, right? Without growth, it means that will be $2 divided by what? By the cost of equity, which is 5%, right? It means that share price of that business is what? $40. Are you following me? Hello? Hello? Are you here?
Yes, I am. What did you say?
Didn't hear what I said.
I didn't hear the last part. It was the network. Sorry. What did you say?
So where did you stop?
We talked about the share price, 40 USD.
Oh, so you got it up to this place, right?
Yes.
All right, that's fine then. And so that's what I was trying to explain. That's what I was trying to explain.
Okay.
That's what I was trying to explain. I told you that this one is without growth, Abi. Yeah.
Yes.
So
Yes.
now
Yes.
let's say we now have a question like with growth. If it's with growth, if we remember the formula, you remember that the formula is DO, right?
Yeah.
Brackets 1
1
plus G divided by what? KE
PO.
minus G. Do you still remember this?
Yes. And the subject was PO equals, Abi? Is it PO
PO.
equals?
No,
Okay,
yeah, PO. No, share price P. Just leave it as share price.
PO.
You don't have to be.
Okay.
It's just share
Okay.
price. It's share price you are getting. It's not whether it's PO, whether it's not PO, right? You
Okay.
get. So just see it as share price, yes. So what do we now do? Let's say for instance now, our DO. Let's say our DO is 2, right? For instance, let's say our growth is let's say 5%. Our cost our cost of equity is 5%. Let's use the former one. Our growth is 3%. These are those refresher classes, so please. So I want to believe we have an idea of what I'm doing. So this will be what? DO 1 plus G, right? Divided by KE minus what? Minus G, right? You bracket it. Most time I like to bracket this one. I like to bracket it so I can get the right answer. So this is it. Oh, why is the ref? Okay. So can you see the share price here?
Yes, I can.
Yeah. So the share is $103. So, like I said, in dividend valuation model, we usually use it to get share price. But now the question is, with this formula that we have now, we now want to use it to calculate cost of equity, right? We want to use it to calculate cost of equity. In the constant approach, right? You said PO. Let me just, PO is PO normal formula is equals to PO is equals to DO divided by KE, right?
Yes.
So if you now want to get KE, is also what? Take KE as what? Subject of what? Do the subject of formula, right? And what?
Okay.
K is equals to what? DO divided by what? PO. Abi?
But that deal, the growth element, you didn't include it. Abi?
No, like I said, this one I first did is without growth first. This is without
Okay,
growth.
without growth. Yes.
Yes,
Okay.
yes. This is without growth.
Yeah.
Now with growth, if we are doing with growth, right? Growth will not be, growth too. Its own is PO, right? DO 1 plus G
Plus G, yeah.
divided by KE
Minus G.
minus G, right? So
Yes.
if we are taking the subject of formula now,
Mhm. To be DO plus 1 plus into bracket 1 plus G.
Okay. I follow.
Divided by.
You don't teach me. You don't.
I'm just trying to do the subject of the formula. So it will be DO in bracket 1 plus G.
DO in bracket 1 plus G.
Divided by PO minus G. So divided by PO.
Divided by what?
PO.
Divided by PO. All right.
Then minus G. So the minus G is not down. It's not down with the PO. It will be separate. Do you understand?
Okay. I'm trying to understand.
To be the same line with, because that's no, it's not minus G. It will be plus G. Because if you look at the G is KE minus G. So I'm taking KE to the other side. If I'm taking KE to the other side, what I'm saying is that if you look at that first formula, KE minus G, I'm taking that KE to the other side. Then I'm multiplying it with PO. So if I'm multiplying it with PO, I will not divide the whole formula with PO. So PO cancel PO. It will now be KE minus G, DO plus G divided by PO. So I want to take that G to the other side now. It will now be DO 1 plus G plus now that G that is leaving KE divided by PO. So I don't know if it makes sense.
I'm following you. Even though I'm confused, though I want to believe I understand what you're saying. It's just because I can't see what you're doing, right? I know you understand what you're doing. Right? Maybe it's the way you're explaining it that I'm not getting fully. But I believe I understand you understand the thought process, right? So this is what we're going to get.
Okay. Is that correct?
You're saying something?
I'm asking, is that the final answer?
No, that's not the final answer. So if I go to get KE, this is what your KE will be. Your KE will be when you do the subject of formula, right?
Yeah,
you get DO
1 plus
brackets 1 plus G divided by
PO plus G.
Yeah, plus not the plus G will be
it will be
so
up.
let me make it will be up. Yeah. So that's what I'm saying. Because I'm using an I'm using an Excel. Yes. I said I know I understand what you are saying. So it will be up, which is this G, right?
Yes.
When we do the Soreto formula. So I think that's clear. So that's how to calculate your KE. So and normally for questions that is relating to calculating cost of equity using the dividend valuation method, they would have given you your share price, right?
Yeah.
They would have given you your share price and other parameters. So it's just for you to calculate. It's just for you to calculate the cost of equity. And there are some questions again. I don't know if you remember this. There are some questions that they won't give you. They won't give you the what are they calling it? They'll give you the growth rate. You have to calculate the growth rate yourself. Do you remember?
Yes, I think so.
And what are the two approaches we use in doing that? If you still remember that.
Forgotten.
So we make use of what? Gordon's growth rate.
Okay, yeah, Gordon's
growth rate. And the other one, I think that one is we make use of dividend also. right?
Is
We
it
use the dividend growth to. Is it what?
No, you said dividend. I'm agreeing to what you're saying.
Yeah, so there's another formula, dividend, where you use the dividend. If let's say for instance now, right, we use the dividend from at the end minus the dividend from at the beginning, right, divided by the first year dividend to get what the growth pattern. I'm trying to get out the formula for that one. So when I get it, I will share with us the dividend using the dividend growth model. So we also use that to calculate that. So let's move on. So that's that about valuing when we are doing valuation, right? So let's just answer this question. There's one question I have here. Let's just answer it, and would using dividend valuation. I'm trying to bring out a question. Okay. I don't. If you can jot this, I don't know. Can you jot this down, or let me just type. And it's an illustration. We have share capital, 50 cents, $2 million. We have dividend per share. Dividend per share just paid. They just paid it, right? 24 cents. We have dividend paid 4 years ago. $15.25. We have current market returns, 15%, right? We have risk-free rate, 8%, and we have equity beta. We have 0.8. So we have this question, right? Now, I want us to calculate the calculate cost of equity. Cost of equity using CAPM and dividend the dividend growth model. We try. Can we try this in just 5 to 7 minutes? You can try it on your own and tell me the answer. If you did we get that? Just lay your hands on it, solve the one you can solve, and let me know, please.
Okay.
All right.
For Kaplan, the K is 12%.
Okay.
Then
What did
for
you say? The K is what?
12%.
Using capping?
Kaplan, yeah.
Why are you calling it Kaplan? Are you calling Kaplan or capping?
Capping. Capping.
Don't say Kaplan, no. It's not Kaplan, no. Is it Kaplan textbook you are using to read?
Huh?
I said, do you use Kaplan textbook to read?
Yes, I use Kaplan textbook.
Oh, maybe that's why you're calling Kaplan.
Okay.
All right, so please let me.
So 12% for Kaplan.
Okay, what about the other one? Can you solve the other one? You said 12%. All right, continue. We're still together.
The first one.
Isn't the time? Wow, easy. Hey. It's really advanced.
I'm not really sure, but I think for the dividend is
So the dividend is what?
Wow. That needs to ring again.
the dividend. I will use that first. Let me see that first formula. Sorry. No, the one without growth. GO over PO. So I think 48%. Kind of.
If I want before that,
Okay, so let's solve together. You said you're using your capping approach. You got what?
12%.
12%. All right. Okay, so let's moment of truth. I don't know. Are you the only one in class? Let me even see. Mr. Austino, I didn't hear from you at all.
I'm here. Just that this there's a place that I'm confused at a point there.
Confused, Ke.
Next time, sir.
Well, you know the good thing about this is a recorded class, so I think you can go back and watch it clearly to understand. Because we have limited time now. If I say I should go back again, sure you understand. Yeah. So since this class is a recorded video class, so I know when you go back to the class again and watch the video, you will pick up one or two. Yeah. So let's move on. So let's calculate the cost of equity using cap. Cap might be different, right? Because we have all the data we need here. we have all the data we need there. So how do we do it? Is this is equals to your risk-free rate, right? Plus your equity beta, right? Multiplied by your current market return minus your what? Minus your risk-free rate, right? If I'm wrong, tell me. Oh.
It's equity beta plus T plus risk-free rate. I mean,
your risk-free rate first, which is your 75.
Sorry, I
risk-free rate
changed my
first.
answer.
You've changed your answer.
7.0.
What do you have?
It's 7.0 or 6.96.
That's your answer. 6.96, Abi.
Yes, or 7.0.
Noted. From 12% to 6.9. Maybe the first one you got was 12%, Abi.
Yes, yes.
Oh, thank you. And now it's 6.96. Okay, we're in the moment of truth. You know, by the time I click on enter now, we'll see whether you are right or wrong.
Okay.
So let's click on enter. So what's it giving us here? So the answer is 13.6. So what did you do differently? How did you get your 12 points and how did you get your 6? And me, I'm getting 13. Eh?
The answer is 13.
Have you seen when you made the mistake?
Yes, I've seen it. It's the multiplication and addition.
So please, we have to be very careful. I know. I want to ask you a question. Is it biro and paper you use or you use the system to calculate? What did you use?
I use biro and paper. That is where the.
Do you know it's even more easier. It's more easier to use paper and biro than even use Excel. Hope you know.
Is this Excel? The way you're using it is confusing me somehow.
So you see now. And the truth of the matter is even this Excel you are going to use in the exam hall. Hope you know.
Sure.
So I said it in the first class. I don't know if you were there or still know. I said if I were you and you want to write this thesis.
Not the first class.
Come again, Ostino.
I'm not there in that first class. So I'm not. I'm not there. Yes.
Oh, okay. Apologies. You were not in the first class. So I said, though the recording is available, you can ask the admin, right? I would confirm from them. So I want to believe that if you've paid, you should be able to have access to the videos, right? So the first video, where that was the first class, right? I explained to everyone. I said, if I were them, the best thing at this stage, if you are practicing, don't practice with biro and paper. You need to start making use of Excel, so that by the time you are getting towards the exam period, you will master it. And that is the gospel truth, right? You need to start what? You need to start making use of the Excel proper, so that you start getting mastery to build speed on how to make use of Excel properly, and so that you won't even make error using Excel. You know, that's the most painful part. When you know something and it's because of Excel, you are not going to fail it. You know, that one is more painful than any other thing, right? Are we all there?
Yeah. I'm here. I'm with you.
So please start learning how to use Excel. I will share this with you.
No problem.
I will share this Excel so that you can see how I go about things, so that you can be using that approach when you are solving your questions, right? One of the things that really helped me was that I practiced with Excel a lot. So by the time in the exam, it was not a big deal for me. It was not a big deal. I was just flowing. And I don't know if you were in the last class. By the grace of God, I was top 3 best Nigerian students in this course during my time.
Wow.
Yeah. So I told them in the last class that you are in the right place, and every error that I made when I was practicing, those are the errors I'm now pointing out to you as a take home. You know, I talked about that market risk part, the market risk premium. I think the last class I talked about something also. So all the places I know that students make error that I was able to correct during my practice, I'm going to be sharing them with you so that you won't fall into those errors also. So please, anywhere you see me say take notes, take notes. I know what I'm saying and I know why I'm murmuring on it, so that you will not fall into those errors that students fall into, right? So once again, you are in one of the best tutorial center, right? And you know we are just starting the ACCA wing of it, and also, like I said, I was top 3, right? So if it's about this AFM, I think I have what it takes to train you, and I have an idea of all the things you need to do to pass in this exam. And I pray good Lord to grant you success. So that is that for capping, right? So Z, I know you've known where you made the error. So this is the capping. Now let's move to the dividend valuation method approach, DVM. So
Dividend valuation method.
yes, using dividend valuation method, right? You know, we're giving capping, and also we can also make use of the dividend growth model to calculate the cost of equity. In the DVM, what do we have? The formula, I know, if I remember vividly, I know the formula is the current dividend divided by the base dividend, which is usually the dividend as at the beginning, right? Root of it, pending the number of years, as the case may be. I won't be able to write it here because you know I'm using Excel, but from this question, you can go and read it up, and you will see you check it from textbook or whichever way. And if you don't see it, I can drop it for you. When in the next class, I can build a slide on that and just show you how it is. But from this question, let's just solve the question, and you will see it. You will understand if you still remember. So Z, are you there? I stopped hearing you. Hello, Z. Are you with us?
Maybe it's network.
Maybe it's network, though she's still present, but let me just solve it. So for the DVM, to calculate the cost of equity, what do we need to do first? We need to get the growth, right? We need to get the growth. There are two things we need to get the growth. We need to get the growth. And how do we get the growth? These are to get the growth. You know, they said the dividend per share that they just paid is 24 cents. Please just be looking at the question, 24 cents. And they said the dividend paid 4 years ago was what? 15.25, right? So to get the growth, right? To get the growth, it will be what they just paid, which is 24, right? Divided by what was paid 4 years ago, which is 15.25. I don't know if you still remember your compounded annual growth rate, CAGR. So it's usually CAGR, which is also known as geometric mean, right? That's what we use to calculate that kind of growth. So you use the dividend that they paid now, divided by the dividend that they paid 4 years ago, multiplied by and taking the root of the number of years, right? So in doing that, this is how to do it using Excel. Just watch. This is it.
Is this not too much?
Oh, sorry. I was supposed to You want to get the growth, this is it. Apologies. -1. So this is it.
So you got it then, but it's the other way around.
What did you say?
I said I got it, but it's the other way around.
It's the other. She said it's the other way around. Okay, oh, it's the other way around. So these are to use DVM to get what we just get here. No, sorry, oh, you missed something. Oh, what we get is growth rates we got here. Oh. We've not gotten the DVM. Oh. What we just got here first is the growth. Are we following?
What's the formula for the growth rate?
You know, formula for growth. If you remember, when we make use of I think you were off for a while. That's why you didn't follow. So formula for growth rate is what? When you are trying to check growth, you know, I said there are two approach. We can use Gordon, or we can use the dividend growth model approach, right? And you know, when you are using the dividend growth model approach, what we usually use is geometric mean or compounded annual growth rate. Compounded annual growth rate or geometric mean. And what is that? What we do is current dividend that you received this year divided by what you received.
Current markets.
What you received in the first year, right? Which is the base dividend, right? You now take what the root of the number of years.
-1.
Do you understand? So this is the formula.
Okay.
Yeah.
Dividend per share. Dividend per share divided by dividend divided by the good.
What happened? Talk to me. Any issue?
You are trying to calculate the growth.
Yes. Yes, we're trying to calculate the growth.
Okay.
So is that clear?
Yes.
All right. So that's to calculate growth. So now let's move on. So for us to now calculate cost of equity, right, using the dividend growth model, I know we've established that this is how to calculate it. They will give us the DO, right? We already have our DO. Our DO is 15.25, right?
Okay.
15.25. Our deal, which was paid 4 years ago, was 15.25. We'll now have 1 plus G, right? Bracket 1 plus G. Our G is 12%.
Okay.
Right? C84, which is 12%. Divided by what?
PO. That's
PO. But yeah, we're even giving PO. What we have is so there's no PO here. So let's just do an assumption. Let's do an assumption. Let's call PO. Let's call price. Let's just call price. Maybe 10 naira. We're just using this question to solve something, right? Let's just call price. Share price. Let's just call it 10 naira. And we're just trying something, right? Let's just call it $10, right? To solve something. This question was actually for something else, but because I just wanted us to see how we can use DVM to calculate cost of equity, right? So we're just assuming, right? Let's call the share price 10, right? So this will be this divided by PO, right? PO is 10. That's the assumption in this question, right? And so let's continue. Yeah. So we close the bracket. Learn to use bracket in the exam.
Right.
I'm with you.
Why are we using the 15.25? Why not 64? 24 rather.
You know, like I said, DO is your this thing. DO is your base dividend. That's dividend you paid first. That's why we're using it. 24 is what you paid current.
But it was that 24 we used to get the growth.
No, now. So yeah, I think okay, let me go back. Let me go back. When we calculated growth, you know, I told you that DVM, you know, this DVM, you're using DVM, you're using dividend valuation method to get cost of equity. Hold that first. You're not using dividend growth model. You're using dividend growth model to get the growth rate. There are two different. Now, in this question, right? In this question, the way I framed it, we are to look for cost of equity using what? Capping or DVM, right? We solved for capping because we have all the data, which is this guy, 13.6. But for DVM, to get the cost of equity, right, we need all these factors. We need your DO, we need your growth rate, we need your PO, and we need your G. We have DO, we have G, we don't have G. Initially, we didn't have G from this question. We had to derive G ourselves, right? We didn't have G. We didn't have we have PO. PO was what I introduced as $10 per share, right?
Okay.
PO was what I introduced as $10 per share. Please be following. G, we didn't have G before, right? But we have DO. Our DO is our the dividend that was first paid, right? Which is what was paid 4 years ago, 15.25. Please be following. This 24 is what is paid now. Just paid. You can see just paid. Now, if I want to calculate growth rate using dividend growth model, what am I trying to get? I want to see between what was paid 4 years ago and what was paid now, what is the growth rate? That's what I will use in getting growth rate. And how do I do that? Two ways to go about. The only way to go about it is using what? Compounded annual growth rate, which is also geometric mean. And how do we use geometric mean? You use this what was n now, which is this formula 24. Okay. What was n now divided by what was n 4 years ago, 15.25, right? You now take the root of the number. Many what was n before 4 years ago, and now it's 4 years, right? 1 divided by 4 bracket minus 1. That's how to get growth rate.
Yeah.
What we just get here is G.
Understand that part.
I'm with you now.
My question is, when you are calculating the KE, why did you use 15.25 instead of 24 cents?
So the reason why I'm using 15.25, right? The reason why I'm using the 15.25 is because when we were calculating our dividend growth model, the dividend growth, sorry, when we are calculating our dividend growth, our DO, we assume our DO, which is the base this thing, to be 15.25. That's your first dividend, the dividend you paid first. You know the dividend it depends on the okay. Don't let me confuse us. Okay, so my question for you, why do you think we should use 24? Let me ask you. Let me so that I can be on your page. Why do you think we should use 24 cents?
I feel 24 is more realistic than, because this div is years ago, and we just want to calculate this KE. It doesn't really relate to something that is paid years ago. For something paid years ago is for you to get the growth rate, like you said, the rate at which the dividend is growing. That's why you need that 15.25, which we have gotten 12%. I want to get the KE, that's the cost of equity. So we should reflect it on what we just paid instead of paid years ago. It's not like I really don't know if I'm complicated.
No, I think I understand your thought process. I think you're right on this. You're right on this because like I said, this question will come, right? So you understand the angle you are speaking, right? Sure, you understand. I understand from the angle. What you're saying is, since it's the current dividend, right? For us to get the cost of equity, right? It should be like based on current realities. That's what you're saying, right?
Because this 4 years is something I wanted to know the rate that it is growing. That's why that information is given. So we want to know the current reality. We are going to use that 24 instead of the 15.25.
All right, let's work. Let's see how that goes. Let's work with 24. Let's work with 24. Let me take you on this. Let me take you on this. So let's work with 24, right? So if we are working with 24, so let's work with 24. 1 plus C, which is C84, right? Your growth divided by the share price, and plus your G.
I'll make it 0.24 instead of 24.
It's supposed to be 0.24 actually, because it's cent. Apologies. So 0.24. Yes, you're right. It's cent. So 0.24, right? And
1
plus G
divided by plus G.
So our G is 12% now. So
Yes.
So let's see. What have we done wrong here? Let's see. Okay. So this 15%, yeah. So this 14.69%.
Okay.
Right.
Okay.
Dividend growth model approach, right?
Yes.
Using DVM to get K, we're going to have 14.69. Using capping, we're going to get what? 13.60. Is that clear?
Yes.
Yeah. All right. So let me see if there's anything what we can do again from this part. So if you remember, right, there's something we can also get from this question. Do you know we can also get the share price? Do you know at this share price, I derived it. I just assumed something because I was trying to get something. If you remember, this share price, I assumed, right? Because I wanted us to use the dividend growth model to arrive at our cost of equity.
Yes.
So I want to take this off. This question was not tailored towards using DVM to get cost of equity, right? Like I said, this question, I just used it to calculate so that we can have an idea of how to use DVM approach to get cost of equity and capital to get cost of equity. But let's move on from that. I want us to show something before we end for today. Now we've understood how to use capping. We've understood how to use the dividend valuation method using the dividend growth model to get cost of equity, right? The next class, we might try using Gordon if there's time, if time permits us. But at least let's just hold this for now, right? And then we continue on this question. Let's see what we can do with this question again. Now, in this question, You also notice that this is the growth, 12% growth, right?
Okay.
And the share price, I told you I assumed this one, so let me take it off. The share price was assumed, so I've taken it off. Now let's move on to, from this question, if they ask us to calculate the share price, how do we calculate the share price?
We can change the formula like DO, PO equals to DO plus G divided by K minus. But the K was not given though.
The what?
Like we can change the formula like PO and all that, but the KE in the question was not given.
Thank you very much. You said the K was not given, right?
Yeah.
But don't forget, in this question, they've given us capping data to get your KE.
Okay, we
So
can
this
use,
is your KE.
okay, we can use that. Makes sense.
Yes. Do you understand?
Yeah.
So this is your KE.
Okay.
Yes.
We can
The
just
reason why so the reason why they gave us that dividend, all this dividend data, right, is just to get your what? Your growth.
Your growth. Okay. Makes sense.
Sure you get. So you can see that the one I added, that dividend, using that DVM to calculate KE, I just added it us to sure you get.
Yes.
The question originally was not designed to do that, right? That the question was to calculate your share price and your capping, your cost of equity, your growth, and your share price from this data. We only just infuse that just to have a broader knowledge of how to use. So let's say they give you a DVM, a question, and they tell you to use DVM and the dividend growth model to calculate your cost of equity. That's what you use. That one we did before. That's how you go about it. So now on this one, let's now calculate the share price, right? Which is PO.
Okay.
So for PO, what do we do? Now we bring the formula. This guy, right?
DO. Yeah.
So we use DO,
Mm.
and our DO will be what now?
24 cents.
Yes. And thank you for bringing that up the other time. It was supposed to be 24 cents, right? It was supposed to be 24 cents, not the 15.25 I was using. So you're correct on that. Thank you for that. Thank you for that. Yeah, so it's 0.24, right? Multiplied by what?
Multiplied by 1 plus 12%.
So multiplied by 1 plus G, right? So your 1 plus 12%.
Yeah. Divided by 13.6.
Divided by 13.6.
0.136. Yeah, 13.6. Minus
But
12.
that what I wanted to remind you. I thought you forgot that. You're supposed to is K minus G. So
12%.
So
16.85.
yeah.
$16.
Are you also calculating it from your hand too?
Yes, 16.8.
Okay, so that means we're on point, right?
Yes.
All right. So if it's 16.85, that's in what? That means the share price is what? $16.85. If the share price is $16.85, we've gotten this.
Yes.
Do you know we can go further again?
Yes, to calculate the KE, right?
What do you think?
We can use that
to get the what?
To calculate a new KE, like for DIM.
Yeah, okay, for DVM, Abi.
Yes, we can use it to calculate a new KE.
Yeah, you can use that to calculate the new KE for dividends. You can do that one in your house. I think after at least you've already gotten the approach, right? I've done that using a dummy share price. So it's not the same approach you use for that. But there's one thing again I want us to know that we can calculate. What do you think we can calculate again? All right, not to waste our time, we can get the market capitalization.
Okay, that's a new one.
That's another question. That's another thing we can get from this question. You know, when you have your share price, what's the formula for your market capitalization? Let me start with that.
No idea.
No idea. So market capitalization is just, oh, okay. I solved it the other time. I told us in this question, if you remember this question, the first one we first did. If you remember this question, do you remember this one?
Yes.
I said your ordinary share is what? 2,000, right?
Yeah.
And in this question, they had given us what the market is, what your shares is likely to trade in the market. What did they give us here?
3.7.
75. And I said to get your market value of equity, what do we need to do? You remember?
You multiply
both, Abi.
With that, yes.
And I said this one, if you remember, I said this 2,000. You know, this is your statement of financial position. It means that this 2,000 is 2,000 naira or 2,000. Because if you remember, I said, this ordinary share will be $1 per shares. Do you remember that?
Yes.
And I said, for you to get the unit of shares, it will be this $2,000 divided by the what? Nominal share price of 1 naira to get 2,000 units. If you remember that.
Okay.
Yes, I remember saying that. Now, this one we just got now, this 16.85 we just got now.
Yeah.
That we went through all this long journey to get. This is it that was given in the question, 3.75. Are you following?
Yes, I can.
Yes. Is this what we got? So you can see that at advanced, in a skills level, they can give you question like this. They would have given you everything. It's just for you to plug and play to calculate WACC. But at advanced level, you have to, all these things that they gave you free of charge, you'll be the one to calculate it yourself. You can see these ordinary shares now that they gave you 3.75 direct in this question. It took us how many steps to calculate it here to get this 16.85? This cost of equity that they gave you simple here, 20%. It took us to use CAPM, right, to get it. Are you following me?
Yes, yes.
And it also took us using DVM. That one that we got, is it, I can't remember, maybe 14.69 or something. Using DVM approach. It took us that level to get cost of equity. So please, just be following. So meaning now, to now get this market capitalization, what do you need to do? From this one I've explained to you now. What
you do is, please, can you go back to the question? Maybe 2 million divided by 50 cents times share price.
Madam, you don't need class anymore now.
Let go set your calculation.
Hello, madam.
Olga.
Z. Just go and write the exam like this. You don't need to come to class again.
I'm failed. Write the exam, I'm failed.
As well. So yeah, you're right. So it shows that you are following in the class. So what you just need to do is what? This 16.85, right? Multiply by what? 2 million divided by 0.5.
You didn't put the divide sign.
Sorry, I made an error. Divided by 0.5.
200,000 I wrote.
Is it 200 I wrote? Okay. So this is it. So this is the market capitalization.
Okay. All right. So market capitalization of the total shares, right?
Yes.
The total value.
So is this market capitalization is this market capitalization you will now use when you are doing WACC. Are you following?
Okay.
You know, in that question, we multiply this 3.75 multiplied by 2,000. That's what we use for our WACC. If you remember this place,
Yeah.
when we did this guy here.
Okay.
You know, we said 3.75 multiplied by this 2,000 units, right?
Okay.
That we got 7.5.
Okay. Yes. Hello? Can't hear you.
Hello, maybe.
All the children, all the students, all the people who work with them, they give them food. So I government food now. I'm not busy buying. I government they provide food everything. All of they give them when they say buy food so no food for us for now. So I put food for us. Give all of the money when they buy food so.